Well, we welcome to the set Mr. Chris Swift of Swift Trading Incorporated in Nashville. He joins us right now, and he will shed his insight into the markets. And that could be quite an undertaking today.
It might not be too much undertaking there.
What the markets are doing. So I guess with that in mind, let's put on our hard hats and our the flak jackets here. Let's take a look at the markets. On the grain, here we go. Corn now showing a nickel loss at 3.72. We have July down 4.5, December down 4.5. It's at 381.5. If you move on to our soybean market right now, you currently have the March contract down 17.25 at 8.7325, and September is down 14.5 cents. And looking at the wheat market in the Chicago March wheat, we're down 14.25 at 536.75. Kansas City on the March wheat is also lower. We're down 12.5 cents. We're trading at $4.56 per bushel. And Minneapolis wheat has also been under pressure this morning. We're down almost 9 cents at 517.25 right now. So, all right, give us your expert opinion here. We had an overnight export sale of soybeans to Mexico, over 100,000 tons again. Should have been bullish news, and they totally ignored that one, didn't they?
Yep. Outside market forces are probably the most to blame this morning. We've seen the equities markets down pretty sharply. Our interest rates are driving lower, just like if we were in a major recession or something. But it's probably more outside market forces than it is the actual grain market or meat markets themselves.
So I saw where the dollar value was actually firming up a little bit this morning, but the Dow, my goodness, down like almost 800 points last time I checked here.
Yeah.
Is that just going to put shivers through the entire ag complex now?
Well, I don't think so, because them rising the same way didn't put anything into the ag markets. So, I mean, we've risen and risen and risen in the equities markets for months now. That hasn't done anything to it. So I don't know why, when you back it off a little bit, that would have that much of an meaning to the commodities market. I think it's initial shock is all it is. We finally got a little break in the equities markets, and if anything were really disturbing, it would be interest rates. Why are we having to continue to shove interest rates down so hard in order to either A, continue with stimulus, or fight a recession of some kind? There's too many conflictions going on out there really to know just yet.
So you look at this as more of a Monday herd mentality then?
I think so, yeah. I don't think it has anything to do with the grain market nor the meat market at all. And it might come to that eventually, but right off the top, it looks like somebody took some profits in the equity markets and they spread more of the coronavirus news around. They kind of upped it up a little bit this weekend, and so kind of spooked some people, and down you go.
Is there any support anywhere nearby on the grains right now, or have we blown it all out?
Well, no, not really. If you look at the corn market and the bean market, they had stabilized for probably close to 3 weeks now. So they just broke out of those little stabilizations to the downside. More likely than not, those will produce some weak technical indicator readings. So I think you're probably looking at some low end, and especially for the corn market. Corn market could really see some lows down in here pretty quick.
Yeah, it's been kind of comatose here for about a month and a half, from what I understand.
And so now you get a little spike low down through here. Anybody that's a purveyor of corn, they might look at this as a good opportunity.
Interesting. All right. Always a silver lining.
Sure, absolutely.
All right, we'll come back here in a moment. We'll talk more with this guy right here, Chris Swift, and we'll talk livestock trade after this break.
Are you looking for...
Well, Chris Swift is still here. He's going to talk about livestock markets with us. And with that in mind here, let's go ahead and bring up live cattle first. Let's get right into this. When we opened up this morning, we actually hit limit down right at the open on a couple of contracts. Currently, you have the April contract now down 278 at 115.47 per hundredweight. So it is trading. It's not limit down anymore, but boy, it's not that far from it. You can see it from there. June down 240 at 107.88. Now, if we look at our feeder cattle market to start things out, we have March down 240. We're at 137.80, and we have the April contract down 255 now at 139.55 per hundredweight. But I believe that one did hit limit down this morning, and then it bounced sharply off of that. But it's still fairly sharply lower. Okay, now to the lean hogs. Here we go. The lean hogs really watching what's going on in China with keen interest. April down 213 at 64.90. The May contract $2.10 lower at 71.90, and June almost $2 lower right now. So let's catch our breath and take a look at this. On
Okay.
the cattle, they hit limit down right off the bat, even though it seemed by some that cattle on feed report did not look all that bad.
No,
on Friday.
it was very vanilla on Friday. They showed 99% placed and 102 on feed, which was the same number last month. Looks like placements have been a little slow coming in the month of February, so we kind of anticipate first quarter placements to be down just a little bit over last year. And with the great beef demand that we've got, our exports have been looking up. I think this is just a little blip. Why traders had to take it down, to this low, I'm not real sure, but it really increases that basis gap now between the fat cattle market and the current cash market. Trade 120 on Friday, so it probably makes for a little bit more of an opportunity to try to converge that basis more with futures going higher than it would, really thinking that the cash market's going to come
Don't
lower.
we typically see more of a correlation between cattle and the, let's say, the Dow Jones Industrial Average? It used to be, they said, if it went really well, there'd be more demand for the beef.
And there is probably some truism to that. We all look at discretionary spending habit, and consumers' discretionary spending habit has a tendency to either be greater or lesser depending upon what their wealth is. And because we look at the equities market as a portion of our wealth, and we tend to think that those type market movements might impact our beef demand to it. But really, crude oil probably is one of the better indicators of what we see in the cattle market a lot of times, is that energy. When there's really good, strong energy usage out there,
Really?
there tends to be other needs out there. The economy's really moving. That's what we have to have is energy to make the economy move. So
Well, crude oil took a
it
beating this morning.
did
It was
indeed.
down
Yeah,
like
it was backwards
230,
today.
I believe,
so.
right out of the gate.
Yeah.
The hog market, is this just mainly dominated now by coronavirus? Or
Well-
what about that March 2nd deadline when they're going to maybe do away with those tariffs?
Yeah, and I think that will help tremendously. We just have an overproduction problem here in the United States. We have got more hogs than we know what to do with, and that pork is stacking up now inside the coolers, and we're waiting for a venue to move it out to. And as soon as we start to do that, then I think hog prices will improve.
So it's a waiting game.
It is.
All right. Well, thank you for coming in. I
Absolutely.
appreciate that very
Pleasure.
much. Good to have you again.
Thank
Chris
you.
Swift of Swift Trading Incorporated in Nashville.
All right, as always, thank you, gentlemen, very much.